Such a short notice. Today, the Bank of Ghana has released its financial statement for 2025. As expected in a year of major economic stabilization, the financial results reflect both the progress made and the cost of that progress. I want to take a few moments to help Ghanaians understand what these numbers mean, and just as importantly, what they do not mean. It is important for us to reflect on the mandate of the Bank of Ghana as it is enshrined in the Bank of Ghana's Act 2002, Act 612, and as amended by Act 918 of 2016 and Act 1158 of 2025, and under the Public Financial Management Act 2016, Act 921. Its mandate is set out in law. One is to maintain price stability, ensure stability of the financial system, manage Ghana's foreign reserve, and support overall economic stability. It is not and was never intended to be a profit maximization institution. The mistake any observer can make in reading these results is to judge a central bank by the standard of a commercial company. The right test of a central bank's annual performance is whether it has delivered on its statutory mandate, and by that test, 2025 was a year of significant achievement. Ladies and gentlemen of the press, let me state the headline numbers to indicate the financial results as published by the Bank of Ghana. The bank reported a net cost, or to some people, loss for 2025 of 15.6 billion Ghana cedis compared to a loss of 9.4 billion Ghana cedis in 2024. Other comprehensive income recorded a charge of 19.32 billion, reflecting the impact of a stronger cedi on the cedi value of the bank foreign reserves. I'll take time and explain them. The net equity position of the bank stood at negative 61.3 billion as at the end of 2024, down from a positive 1.2 billion compared to a negative equity of 35 billion as at the end of 2025, cumulatively bringing the net equity position of the bank to about 96.3 billion. This simply means that as at the time President Mahama assumed office, the total negative equity position of Bank of Ghana was 61.3 billion. Meanwhile, as at 2021, we had a positive net equity of 1.2 billion Ghana cedis. These numbers reflect the cost of work that was done. What have we achieved to see these costs over the past 1 year? Ghana's economy has been transformed. Inflation has fallen from 23.8% as at the end of 2024 to 5.4% by the end of 2025, and to 3.2% by March of this year, the 15th consecutive month of decline. For the woman buying tomato at the market, that means the price of a basket of food is stable and not increasing drastically as it did a year ago. For the family paying school fees, electricity, and hospital costs, the stability is real. What lower inflation made possible? What made the lower inflation possible? The cost of 16.7 billion cost was incurred in 2025 through the Bank of Ghana open market operation, interest paid to absorb excess liquidity in the market. This led to inflation falling from 54.1% in 2022 to 3.2% in March this year. The monetary policy rate of government that forms the basis of the Ghana reference rate and the interbank rate fell from about 30%, that made cost of doing business so expensive, to about 14%. Lending rate has also fallen from about 35.6% in 2022 to 19.2% as at the end of 2025. Private capital demands, the real credit growth available to the private sector, also grew by 0.2%, and it has increased also to about 15.3% by February 2026. Government cost collapse in terms of the 91 Treasury bill rate, moving from about 35.2% in 2022 to 9% as at February 2026. And then long-term planning returns through the fixed contracts and the 3-year investment hiring plans became viable. And that's why you see a lot of development going on in the Bank of Ghana. And then confidence also surges. Consumer confidence has also increased from 79.2 percentage points to 111.7 percentage points as of January 2026. Ladies and gentlemen, the stabilization of the cedi that we saw, which lost its value of 19% in 2024, for the first time in many years gained its trend of 41% in 2025 and named the strongest currency of any emerging market in the world in 2025. The international reserve grew from 9.1 billion as at the end of 2024 to 13.8 billion as at the end of 2025, and now stood at 14.5 billion as at February 2026, the highest reserve Ghana has ever recorded in history. Policy rate has also seen a cut from 27% at the end of 2024 to 14% as at March 2026. The average lending rates have followed it down from 30.2% to 17.7%. That means cheaper loans for small business owners trying to expand, and farmer buying inputs, and trader who borrows to stock his shop, and the young couple buying for their first time. Ghana's public debt has fallen from about 62.5% of GDP to 45% of GDP as part of the broader stabilization effort of the Bank of Ghana and the Ministry of Finance. The economy grew by 6% in 2025 against a projected 4% in the year 2025. Businesses and consumer confidence are at record highs. These are the costs or the benefit as a result of the cost done by the Bank of Ghana. Consider where we would have been today had this not work been done. If you wanted to reduce the equity position of government, consider the effect we would have been suffering as a result of that decision. Inflation would have still been high at about 23.8%. CD would have still been weakening week after week. Reserve running lower, lending rate above 30%, and all this happening in a global environment of war, of trade tariffs reshaping the international ecosystem, of capital flight from emerging markets and other economies in our region, and beyond all are still struggling with all these pressures. Ghana is still resilient and not affected by that. The bank built a room we can now have to navigate this moment. These outcomes did not just happen by accident. They are as a result of deliberate policy actions, and those actions had financial implications for the bank itself. The costs you see in the financial statements are the cost of producing the outcomes that you are living through currently. The institutions carried them on its books. The country received the benefits. The Bank of Ghana had to absorb the costs, but the country, you and